D-Day, the longest day, represents the turning point of World War II. It marked the initial invasion of the Allied forces of Western Europe and the eventual defeat of Germany. The Allied forces suffered over 10,000 casualties in the invasion, along with 1,557 Americans missing in action. In honor of the 70th anniversary, this June 6th, SD Bullion is proud to announce the launch of D-Day, the first coin of the Heroes SD War Collection in limited mintage. Heroes, don't let them die in vain. Start your Heroes SD War Collection June 6th, only at sdbullion.com. This is the Doc with SilverDoctors.com. Joining us now is one of the foremost experts in the gold and silver industry. He's often referred to as the Admiral. He's the chairman of Sprott Money and chairman and CEO of Sprott Asset Management, Eric Sprott. It's great to have you back on the show, Eric.
Hey, Doc. Happy to be here, and congratulations on all the work you do. I really love your website, and I know it's very valuable to precious metals investors, so keep up the good work.
Well, appreciate that, Eric. I wanted to start off right away here with your thoughts on the state of the physical markets in both gold and silver. I know you have that dream of taking that very last physical bar of gold and silver off the market. Currently, we're not seeing a lot of retail shortages and delays like we saw last summer in 2013, but we're still at record investment demand levels. Up in your neck of the woods, the Canadian Mint, their silver maple sales for Q1 were 8.2 million ounces for the first quarter. That's about 25% higher than their 2013 record, and the U.S. Mint has sold already 22 million Silver Eagles over the first 5 months of the year, which is on pace for another record. And a stat I know you'll take to heart here, the U.S. Mint is selling Silver Eagles to Gold Eagles at a 97-to-1 ratio so far in 2014. So what's your take on the current state of the gold and silver markets, first off? Sure. And then second, if we're already at record investment demand levels right now with sentiment terrible, what might demand and coin sales look like if the silver market would experience like another rally like we saw in 2010 to 11?
Sure. Well, you know, Doc, it's I spent a lot of time looking at the physical markets, and I've written so many articles on it, it just blows me away. And I would sort of reference back to an article I wrote in 2012 which said, you know, do the Western central banks have any gold left? Because my analysis suggested, boy, these guys have got to be suppressing the price of gold, and they can't have much left. And you know, I think they were getting very close to being out of gold, and that's why they had the raid last in 2013. They ended up taking something like 900 tons out of the various ETFs in the world, which was, of course, consumed. And it sort of shows the amount of physical consumption versus supply. Supply is 2,700 tons from the mines, maybe 1,300 from recycling, although that's a number no one can really get a handle on. We had the 900 tons from the ETFs that came out last year. It all got consumed, and of course it got consumed by the eastern countries. I mean, there's various people that suggest that Chinese demand is equivalent to all Western mining, and I would include myself in that. Between what they produce for themselves and consume and what they import, both through Hong Kong and now other, you know, directly into China, I mean, it just looks like they're almost consuming all the mining production in the world, which sort of begs the question, well, where's the gold coming from? And where's the silver coming from? And we've seen data out of Switzerland now that shows where the imports into Switzerland come from, and they come from the UK, the US, and the UK produces no gold, so whose gold is it that the UK is exporting to Switzerland? The U.S. is exporting way beyond what they produce, so where's that gold coming from? And of course, it's always been my conclusion, and most other people that study the physical markets, that the Western central banks continue to find gold somewhere. We've had various commentators say that, you know, they're getting down to the bottom of the vaults because the bars are, you know, dated back to the 60s, things like that. And I just, whenever I look at demand, I think, man, there's more demand than there is supply. Yes, you can mess around with COMEX all you want until someday somebody asks for delivery and they're not going to get delivery. So I'm quite impressed by the demand for the metals on all fronts. And you can even include platinum and palladium in there. All the metals look like there really is a shortage. It just hasn't been allowed to manifest itself because of the control of the futures markets that various brokers have. And We've seen by the UK example, which we should talk about, the Barclays example, what people do in the futures markets. And I might point out, Doc, that one of the things I'm going to find interesting is palladium, which doesn't have futures trade, is within about 3% of its all-time high. And I think if it goes to a new high, it'll tell you what a non-futures market can do and should do. And of course, palladium and platinum are both screaming that there has to be a shortage. And unfortunately, in platinum, there is a futures market, and the commercials have gone massively short to keep things under control. I've always speculated someday there will be that failure. So the demand seems to be there. The reasons to own gold get better by the day. There's no economic recovery. What did the Jürgen Stark, former chairman of the ECB, said? We live in a fictional financial system. I mean, that's what we live in. We live in a fictional financial system. There's no recovery. We spent trillions and trillions of dollars buying bonds. What do we get for it? We got hardly anything for it. And of course, the middle class is just getting routed here because of the serious inflation that they have to face, whether it's, education, healthcare, food costs. Everything's going up, and it's not 2%. We know that, and their wages don't go up by 2%. So we have a very great environment for gold to go higher. It has not been allowed to go higher, and of course I think the reason it's not allowed to go higher is anybody in their right mind knows that printing money is so vastly irresponsible, and of course the irresponsibility would show up in a higher gold price, and in the meantime everyone just, the market's going up, everything's fine, there's no inflation, and everyone's staying calm. But the day is coming when they won't be staying calm because of all these forces that are at work today, whether it's in the economy, in the precious metals markets, on the geopolitical front. I mean, there's so many things going on that are all gold positive. But gold isn't allowed to rise yet, but it will.
Exactly. You touched on the Barclays manipulation incident of a couple of weeks ago, and I find it interesting that the mainstream financial media afterwards really bent over backwards trying to assert that this was just a one-off event isolated to a single trader. Barclays wasn't responsible. It was just this rogue trader, kind of like the claims in the JP Morgan London whale.
Right.
And as you and I know, that certainly wasn't the case, just that it was just a one-off rogue trader. But it appears that after years of denials and scoffing, the story is slowly leaking its way into the mainstream. The Financial Times reported Tuesday that trading to influence the gold price fix was routine in the industry. And I want to read just a bit of the quote from the FT piece here for our listeners, Eric. And I quote, "While the Financial Conduct Authority says the case appears to be a one-off, the work of a single trader, some market professionals have a different view. They claim the practice of nudging a tradable benchmark in order to protect a digital derivatives contract, as a Barclays employee did, was routine in the industry. If I was at the FCA, I would be looking at all banks trading digitals. This could be the tip of the iceberg. There's a massive issue with exotic derivatives and barriers." Now, Eric, this was in the Financial Times, not on Zero Hedge or Silver Doctors or in one of your reports.
Right. We being the fringe crowd, right?
Right. So has the precious metals manipulation story finally achieved a critical mass where the mainstream financial media can really no longer ignore the story but is finally forced to start covering it, Eric? What's your take?
Yeah. Well, we do have the class action lawsuits. We have statements that were made by CFTC commissioners who long ago said it looked like something illegal was going on, although nothing did eventuate from it. We have the Barclays incident. And, of course, that Barclays incident, it was one day for one purpose. And there's 250 trading days in a year. And each one of those days, undoubtedly, there is purpose. And I've always, the more I see what goes on in the futures market, the more you realize that the guys who buy options are basically set up to fail by the dealers because they're collecting the premiums. And there's a theory in our business that the price of a thing that trades in the option market always expires at what they call max pain. And max pain is where the customer loses the most money. And of course, we could use that analogy with the Barclays situation. What was max pain for their customer was to close it at, I think it was was it 1350 or some price like that, and he just arranged to have it. I think it was 13 or 1258 or something. He arranged to have it closed there, and just to inflict max pain on their customer, which is a bit of an oddity. You'd think you might treat customers a little better than that, but it's symptomatic with the whole business, whether it's Forex trading, LIBOR trading, precious metals trading, undoubtedly stock trading. We always see the same thing in stocks. The stocks tend to close where the futures, where the options would cause max pain to everyone. And of course, the dealer scoops all the premiums off. And, you know, these markets are pretty big, and every expiry, there's probably billions of dollars on the table, so it's a routine they just go through. I wasn't aware of these, what they call the digitals in Europe, where I think it's just set at a fixed price that someone will either earn their money or lose some money. So it's a one-off. I guess it's a one-off trade with the bank, and God knows how big those are at the time. And we don't see that, of course, in the options market here in North America. But it might be a huge business, and what a wonderful thing. You're sitting there as a trader thinking, well, me and my buddies can control this price, and we can all write these tickets and basically scoop all the money every option expiry. So there's no doubt that it goes on, has gone on for a long while. Although, Doc, I will draw one difference. I think that, you know, there's been various parties who have manipulated the price of gold. And for sure, the central banks were involved, you know, when they announced they're selling, and then the limited selling, and I think it was all meant to keep the price of gold down. And that may very well have ended in the early 2000s. And then I think the dealers figured out, hold it now, we can do this too, you know, just because we got pretty deep pockets. In fact, a lot of the banks have deeper pockets than the governments, obviously. And we can do this too and skim the options. So I think it's transferred over to the investment dealers who probably have, like, I would hate to think how many billions of dollars are on the table. Just think of that one day when the Barclays trader took it down $20. I mean, I was trying to sit there. Well, how much did I lose that day? Did I lose $5 or $10 million that day? Me and my clients, and we lose that kind of money that day? You know, what about our claim? Now, I grant you it was only for one day at one moment in time, but I think you can set the tape up for what I'm going to call technical failure or technical disappointment, and they all know it, and they play it like a violin here, all to the detriment of bona fide players in the markets.
Sure, and kind of like you're alluding to, I agree that it is multifaceted. We have the dealers skimming, and then we also have the management of perceptions in general. In my mind, goes back to, I think it was November of 2011 or 2012, I forget the year, but when the Swiss pegged the franc to the euro, and it was, I'm trying to remember if it was a Sunday night here in North America that it happened, but 5 minutes prior to the announcement, gold on no news plunged $50
right.
prior to the announcement of pegging the Swiss franc to the euro.
We all know about front-running news, okay? I mean, it's become so obvious that the high-frequency traders and algo traders run the market, and that's why the participation in markets keeps going down. That's why the investment dealers trading, they've announced, you know, it looks like our trading revenues are going to be down 25%. Who'd want to trade it? In fact, I'd almost encourage all people not to trade in options of precious metals, because then there's no dry tinder for the commercial banks to light up. I mean, if nobody bought the option, we just concentrated on the physical metal, I think we'd have a much easier opportunity. But every time we buy an option and we pay that premium to the dealer, well, he's going to try to steal it. So he wants that price. And typically most precious metals buyers are long calls. Like, there's way more calls than puts. So the pressure's always on the downside. So I think it's best just to stay out of that market.
Now I want to switch gears a little bit here, Eric. You came out earlier in the year and stated you thought gold would see new all-time nominal highs in 2014. If I recall, somewhere around 2,400 was the number you're looking for. With gold currently trading around the 1,250 level, that'd be nearly a double from current valuations. I've reminded a lot of people lately about your 2010 call that silver would reach $50 within 6 months when it was trading somewhere around 17 or 18 at the time, and basically you nailed that one. So I'm wondering, do you still believe we'll see new nominal highs in gold in 2014? And I guess if so, how do you see that happening?
Sure, Doc. Well, I mean, it's a great question. Obviously, we've lost some of our time window here, but there's nothing in the physical data that distracts me from thinking that demand is way in excess of supply. Even if you imagine going forward here, I mean, I have to think the supply of gold's going down because we haven't done the exploration. We're not doing the development. It's hard to finance projects. All mines, I mean, the average mine probably has a 10-year life. So, if you're not finding new things and developing new things, I mean, 10 years from now, there would be no gold production on average. I mean, some guys will expire in 2 years and 3 years, and some guys will be 20 years. But, the average life of mine is probably less than 10 years. So I can see going forward where supply is going to be diminishing. I think there's lots of events in the world, and particularly the Chinese, of course, influence in the gold market, let alone if we bring India back into the market, which it looks like they will come back into the market. Their premiums have come way off. It's way more affordable for Indians to buy gold here, and I suggest that they will be buying lots of gold as some of their festivals, religious festivals, come up. And there's been continuing interest in the broad market in people owning gold, and I contend. Well, obviously, there was a shortage of 900 tons last year. We know that because it came out of the ETF and it went somewhere. So far, it looks like we will have a sort of steady state in the ETFs this year. In fact, maybe by the end of the year, if we actually get some momentum going in gold, we could see it reverse. Imagine if people bought 500 tons instead of selling 900 tons. I mean, that's about 40% of change in the supply-demand equation. So I'm still very optimistic. I'm so terribly disappointed that it's taken this long and that we have to go through these events, with the May option expiry where they got to bang it down to $12.50 so everyone loses their money. It's as frustrating as can be. We're in a very tough environment here because nothing seems to make a lot of sense fundamentally. I mean, I'm a fundamental guy, and I mean, I could see companies whose sales go down 9 quarters in a row, and the stock's still trading within 10% of its all-time high. I'm like, what the hell is going on there? You watch these retailers come out with horrible numbers, and yet the markets hangs in there. The market's at an all-time high. It's kind of mind-boggling, but I do believe that there are forces at work in markets which shouldn't be in markets. And I'm referring to, the central banks as a whole, and I'm absolutely convinced they're involved in the gold market. I'm so happy to hear that, the gold's just pouring out of these countries. There's lots of people speculating that London has very little left because I don't think their shipments to Switzerland fell off dramatically either in, I think it was March or April. And I could believe that, hey, they can't keep shipping 100 tons a month. I mean, they don't even produce an ounce of gold. So I still firmly believe that we can get there and that we could have some stunningly fast moves here, particularly if, of course, physical default was ever announced.
In just substantiating those theories that particularly London is running out of gold, but really the Western banking system in general, we had the story here, I think it was Monday, that Bloomberg reported that Ecuador had agreed to lease out over half of its entire gold reserves. It was nearly 500,000 ounces to the Goldman boys for 3 years in exchange for liquidity. And I think we'd both agree it's a fairly safe assumption that Ecuador won't be seeing any of those ounces back in 3 years.
No.
It's probably, we're recording this on Wednesday. It's probably being unloaded in either Shanghai or Hong Kong right now.
Hey, it might have already gone. It probably came into the Forex market last week because maybe Goldman knew they were going to get the 500,000 ounces, so let's just take this sucker down. Or maybe they even knocked it down so they could buy the 14 tons cheap. Who knows? Right. And
this also could be coincidental, but it's nonetheless interesting. The timing comes right after Austria demands an audit request of their gold. And so then we see the price smashed and 500,000 ounces being freed up from Ecuador. They haven't come knocking, calling on you, Eric, have they, for the Fizz gold?
No. Well, everything's counterintuitive in the gold market. Every time there's some data that would tell you that gold should go. For example, today we had the employment data, and it was weak. Gold shoots up all of $2. Then we get the trade deficit, weak. Gold shoots up all of $2, and I'm probably, as I'm speaking, it's flat on the day. You know, like there's nothing seems to ever have a direct relationship because it's not allowed to happen. I mean, most of the gold positive news always results in the price going down because they don't want this relationship of gold to anything. You know, if the trade deficit is working, you don't want gold going up because then people link onto it every damn month. Or employment being weak, you don't want the gold price going up because then people will realize, boy, if the next one's weak, then gold should go higher, and these guys are trying to control it. So it's kind of perverse what happens in the market, but I think most people can take some comfort in the fact that, you know, there's weird things going on in the financial markets, whether it's, you know, we're supposedly tapering, but now all of a sudden Belgium's buying all these bonds, and the guess would be that, you know, the Fed has some swap line with the ECB, and therefore they're buying the bonds in Brussels, and they really haven't decreased their quantitative easing at all. They just found a different route to do it and be able to say, oh, look, we're semi-responsible, which, of course, they haven't been semi-responsible. So I still am very hopeful our day is coming, and it's hard to predict what's going to happen. I still think it has an excellent chance of doing well this year.
It's amazing with the Belgium story that the mainstream news just accepts that at face value, that Belgium is suddenly taking down all of the U.S. treasuries.
Yeah, well, you know, Doc, there is no mainstream news. That's the problem. There's no mainstream news. Mainstream reports what the guys running the system want them to write. That's why websites like yours, Zero Hedge, and others are very interesting because they take a totally different view of things. Like, let's analyze the numbers. Let's not just, you know, put down that they beat expectations. You know, if you lower expectations enough, you'll always beat. I mean, it means nothing. I've always said to people, I will be interested in the stock market again when they stop using the expression beat expectations. Just tell me what the numbers were. Were they up or down? This expectation thing is a bit of a mug's game. So,
well, before we let you go, Eric, I know that you and you guys are excited about the Sprott Natural Resource Symposium in Vancouver in July. I've taken a look at it, and it looks like it's going to be an excellent opportunity for investors to learn from some of the top minds in the natural resource sector. And really, this is an excellent time to invest some funds in the resource sector.
Yeah, get involved. I mean, stocks are cheap. The price of gold's low. They have a very good lineup. I would encourage people to attend. It should be a fun show with lots of excellent speakers. So
yeah, the lineup looks really like a cornucopia of experts in the field. So we'll include a link in the write-up to help our listeners find out some more about it. But we encourage our listeners to take a look and go see the guys at the Sprott Natural Resource Symposium in Vancouver in July. I've been out in British Columbia in July, and just for the scenery, I'd go.
Oh yeah, that's a pretty nice place to be in July.
All right. So for all our listeners interested in finding out more, check out the link in the write-up of the interview. But so Eric, it was great to have you back on the show. It's a pleasure always to have you back.
Okay, Doc, my pleasure, and keep up the great work. I love going to your site. All the best.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve chairmen in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.